Jack Schwager's career runs the gamut from market analyst to author of the Market Wizards books to an online startup today. The recipient of the CTA Expo's 2015 Lifetime Achievement Award in New York, he spoke with John Lothian News about what he knows about top traders and his new venture, Fundseeder, which is looking to provide visibility to the next generation of market wizards.
Traders like somebody like Jim Rogers, who's the world's biggest cynic about technical trading. He's very long-term, fundamental ideas, and done it successfully all his life. His comment about technical analysis is, I never met a rich technician unless you count the ones that sell their services. That's a summary of opinion about the technical analysis. And he's been extremely successful, but you got people like Marty Schwartz who started out as a stock guy and told me he lost money every year trading on fundamentals, and then found technical analysis and got wealthy as a technician, and sort of has exactly the opposite view. So you can take people who have not only different approaches, but have approaches that are polar extremes and consider each other's approaches complete nonsense, and yet they're both extremely successful. People don't like to hear it. People think it's all about finding this great trading method, this great entry approach, being brilliant at finding the great trade. But it's more important, and the great traders all tell you this, it's more important to worry about not losing money than making money. It's more important to figure out how to conserve your capital. It's more risk management really is more important than the method. And so that's another very, very critical element, which beginning traders particularly don't appreciate. It takes traders many years to get that. But risk management is far more important than the methodology. Most of risk management can be achieved with some very, very, very simple rules. Don't risk more than a very small percent of your capital on each trade. That really gets you very far. Don't risk more than a certain percent of your portfolio. And if you hit that point, whatever your stake, you start out with X, you're willing to lose. You pick how many dollars can I lose without being a big deal. If you decide that ahead of time, and if you get to that amount, you stop trading. Take a break. But if they recognize something has changed and they're wrong, they'll act on it. They're not going to say, I really believe I'm still right. The market's going, I'm going to hold on. They're just willing to accept the realities. They're just willing to see the facts as they are. And that's a key element of success. So like a classic example would be Stanley Druckenmiller, who switched from being short in the market to long the day before the October 1987 crash, which to me has to stand as probably one of the biggest mistakes ever made in trading, and yet came out that month okay because he recognized over the weekend he had made an error, and he came in with a plan to get out of that position. And that Monday, I think the markets gapped down like 12% to open, and he had just reversed, the wrong side. And so he had he recognized he was wrong. He didn't try to, say, I'll give it a little time, I'll come back. He came in that morning, he knew what he had to do. He got back out of the position and he went back short again. So that's the epitome of a great trader, sort of recognizing the facts as they are. The markets have definitely gone through a lot of changes, but markets are always changing, and yet they're in some way always the same. It's a bit of a paradox. So what happens is markets go through structural changes. You get like I say, I came in the business, there was on a future side, it was all commodities, there were no financial futures. Now we're in a world where, 80% of it, 90% of it is all financial futures. It's like, that's a big change, right? You come in a world where there are no computers, a few guys are doing some simple stuff on these IBM 360s, just doing some simple program. And now you're in a world where you've got just, incredible quant power being applied by some firm. So those are giant types of, and there's, I listed a lot, there are a lot of them, but there are some big, big changes. Yet, ironically, in some way, the markets are still the same. And why that is true is because the one thing that never changes is human nature and human behavior, and the natural tendencies of humans to have fear, to be greedy, to express those emotions in the market. and that causes certain repetitive patterns. The whole concept was developed by Manuel Bellari, who approached me, and we were colleagues in another venture. And so I joined him as one of the partners. And so what Fundseeder does is think of it as a web search for trading talent. And our goal is to be the meeting place between undiscovered trading talent, or it could be discovered trading talent, but we're really interested in finding undiscovered trading talent, and investors looking for new trading talent. The key thing is to get their numbers up so they're visible to prospective investors looking for trading talent.